Hello class, I'm Mahanam and my group members Mohammed and Bavish will be talking about other comprehensive income. Our video consists of us explaining what is other comprehensive income, then we will explain why businesses would like to use it and when would the appropriate time be to utilize this, along with how. We will then shift our focus to examples of this topic, followed by reporting it on the financial statements. What is it? Other comprehensive income, or OCI for short, is revenues and expenses changes such as gains or losses over a period of time that is not permitted to be included in the net income. However, the values are still added or deducted to the shareholders' equity section and is sometimes listed right after net income. Amounts from sales or repurchase of shares are not included in other comprehensive income.
Why is it used? Understanding and analyzing other comprehensive income can greatly improve the financial analysis within a company. It can help an analyst to get more accurate measure of a company's investment. Since comprehensive income is kept separate from profit, it protects profit from changes that could be caused by fluctuations in fair value, and can inform the user of the financial statement of the cash that would have been received if the investment had been sold at year-end, because the investment is reported at its fair value.
Now that you know what other comprehensive income is, when do you use it? Well, when revenues, expenses, gains, and losses appear in other comprehensive income when they have not yet been realized. Something that has been realized when the underlying transaction has been completed, such as when an investment is sold. When do items in other comprehensive income switch to an unrealized gain or loss? Items in other comprehensive income can also turn into a realized gain or loss. This can happen in many ways. For example, when you sell an investment that currently is recorded as an unrealized gain in other comprehensive income. This affects the net income while it changes the information on the financial reports.
Other comprehensive income is recorded differently in regards to ASPE and IFRS. Under ASPE, companies do not report other comprehensive income. Under IFRS, there are gains and losses that do not affect profit and are not included in profit, but are still added or deducted to shareholders' equity. For companies under IFRS, it is necessary that they prepare a statement of comprehensive income that shows all items included in comprehensive income. There are two formats a company may follow: the all-inclusive format or the separate statement format. For the all-inclusive format, you may include all components of profit or loss and other comprehensive income in a single statement. By showing the revenues and expenses that result to a profit or loss from the income statement, it makes it easier to evaluate a company's profitability. If using this format, the preparation of an income statement is not needed. If using the separate statement format, you would present the income statement followed by a separate statement of comprehensive income. The profit recorded on the statement of comprehensive income is taken from the income statement. Then the other comprehensive income gain or loss are added or deducted from profit to calculate comprehensive income.
Example 1. Company A has invested in bonds, and after a period of time, the value of the bonds changes. Will the change still be recognized on the balance sheet? If not, where? Think about this for a second. Well, the answer here is you recognize the difference in other comprehensive income on the income statement, not the balance sheet. However, once you sell the bonds, you have then realized the gain or loss value associated with the bonds and then can shift the gain or loss out of either comprehensive income or into net income or net loss. Example 2. An employer records the workers' funds for the pension plan into other comprehensive income. Was he right for doing this? Keep in mind that employees have no control over their pension plan funds. Well, although this is the case, he was in fact right for recording in the OCI. Pension plan funds, basically retirement funds, are not considered by many as income as they have absolutely no control over it, but it helps for their future. So recording other comprehensive income may throw people off, but it's the right thing to do.
Now that you know what other comprehensive income is, why you use it, and when you use it, where would you place it on the balance sheet? Well, take a moment to think. Well, other comprehensive income is a no gain or loss account. It is a tricky account to place. It would be put in to the equity section of the balance sheet. It would also be accumulated there, and later on in the financial report, it would be transferred on to the income statement. For example, I would create an example here. I've made a custom example for myself here where I put the equity section for the balance sheet. As you can see, other comprehensive income is placed right beside other accounts in the equity section, for example, retained earnings and owner's capital, and will later on be added to the owner's equity and total liability. Another example is from Microsoft. This equity section from the balance sheet is from the year ended June 30th of 2015. As you can see, they have also placed other comprehensive income under the equity section, as it is reported because in the equity section because it is in neither an asset or liability for the time being.
If a company is reporting under IFRS and using the all-inclusive format to prepare the statement of comprehensive income, would the company have to prepare an income statement? The answer is no. Since the company is using the all-inclusive format, all of the revenues and expenses resulting in a profit or loss found on the income statement would be included in the statement of comprehensive income, making it easier to evaluate a company's profitability. The company would not prepare an income statement if using the all-inclusive format.
Now that you have learned about the all-inclusive format, the company recording under IFRS once again is using the other option called separate statement format. Which financial statement would the accountant use? Options could be the balance sheet, income statement, or statement of comprehensive income. Well, actually, the accountant must present it on the income statement followed by a separate statement of comprehensive income. In this case, the statement of comprehensive income starts with the profit or the loss that was initially reported on the income statement. The other comprehensive income changes are then deducted or added to the profit. The end result should be the comprehensive income. This concludes our video about our topic. We hope you enjoyed.